Greetings, everyone. Hope you're doing well. We'll just to allow others to join our session and then get started. Okay, maybe we'll get started now. Hi, everyone. I hope you are all doing well and enjoying the virtual GrassFi conference so far. My name is Aniket Shah, and I am going to moderate today's session. I am the head of ESG and sustainability research for the Americas for UBS, and I am substituting in for Julie Hudson, who's the global head of ESG research for UBS. The title of our session is Actors and Approaches for Driving Change. We are fortunate to have scholars from around the world who have in different ways analyzed how and whether sustainable finance and business activities impact the real economy and real economy outcomes. In this session, we will have 4 paper presentations, each for 10 minutes, and then we will have 15 to 20 minutes of Q&A at the end. So please do submit any questions, comments, suggestions, etc. in the chat and Q&A function, and we'll be trying our best to get to them at the end of the session. So without further ado, let me ask Alex Clark and Krister Koskelo to present the first paper of the session, Sustainable Finance and Transmission Mechanisms to the Real Economy. Alex and Krister, over to you.
Hello, everyone. Welcome to our presentation. Let me just make sure that my PowerPoint shows up correctly. So welcome everyone to our presentation. We're presenting on sustainable finance and transmission mechanisms to the real economy. I'll do half the presentation. My colleague Alex will do the second half, and our other co-authors are Dr. Lizzie Harnett and Dr. Ben Caldecott. Our analysis really starts from the premise that it's important to link sustainable finance to real economy decisions. That there's been a lot of discussion about growth in different types of sustainable finance instruments, like what counts as green. People are thinking of green bonds and green loans and social bonds and coming up with different sorts of instrument definitions. If you think about the work of the EU taxonomy, you know, that's hundreds and hundreds of pages of basically defining and nailing down what counts as green. But we think that simply investing in green financial products doesn't necessarily equal making the world greener, and indeed that there is a risk of greenwashing. What really counts is how financial products and how financial sector actions make the world greener, how finance transmits to the real economy. So we're looking at how sustainable finance affects the willingness and ability of real economy actors, principally corporations, to address climate risks and contribute to a low carbon transition. We start with a review of transmission mechanisms, which can be found in both the classical financial and economics literature, and then look at some applications to sustainable finance. Again, we're focusing on corporations, not on households. We then look at maximum potential impact by asset class. Then we construct some ideal types of what would an impact maximizer do in each asset class. And finally, we conclude on implications for manager selection and asset allocation. So really the first question is, how does finance affect companies in the real economy? There's obviously lots and lots of literature on this. We focused on 5 main transmission mechanisms. So cost of capital, liquidity, risk management and mitigation, sustainable corporate management and practices, and wider spillover effects. Our analysis first looks at in general. So in the economics and finance literature, we very briefly cover and look into the literature to determine what factors influence these in general. So cost of capital is both cost of debt capital and of equity capital. It's affected by macro factors like the level of interest rates set by a central bank, inflation, and the stage of the business cycle, and micro factors like company level creditworthiness. Liquidity can matter for firms by lowering transaction costs, and better access to liquidity can help incentivize longer-term investments and can bring in new sorts of investors. Financial products and financial actors can help firms manage and mitigate risks through instruments like insurance, policies, derivatives, securitization. Then the shareholder rights, so investors can have always had shareholder rights really since the invention of joint stock companies going back several centuries. Shareholders as part owners have had a role in a say in how the firm is run, but through different time periods, that role has been used to a different extent, and now it's sort of coming back to the fore. And finance also has huge spillover effects, as for example, we see from the global financial crisis. Then we looked at some examples of sustainable finance specifically and how we can find examples of these transmission mechanisms. So in the as regards cost of capital, there are some banks that have set policies that are starting to drive a wedge between the cost of capital for sustainable projects and unsustainable projects. So for example, on coal, tar sands, deep sea oil, some banks have stopped financing these completely. There's no clear evidence of improved liquidity for sustainable projects or firms as compared to unsustainable ones, although this might change with ESG requirements from stock exchanges. There have been some changes in insurance provision around managing climate risk. So some insurers in Europe and America are refusing to insure, for example, new coal-fired power plants. That removes that risk mitigation option and makes it much less likely that power plant is built. The transmission mechanism with the biggest literature in general and a lot of literature in support of this mechanism's strength is the influence of investors and shareholders. So there's a measurable impact on corporate management and practices. Management do tend to comply with requests and make measurable changes on relatively short timescales. There's little evidence of spillover effects as yet when comparing sort of sustainable finance specifically. Then we looked at the potential impact of each mechanism by asset class. So we looked at 5 asset classes: equities, fixed income, private equity, real assets, and hedge funds, and split those up into passive and active for equities, and bonds and loans for fixed income. And I'll let my colleague Alex Clark take over from here.
Great, thank you, Krista. So moving swiftly on because we're limited on time. What you can see on this slide is a simplified, fairly stylistic assessment of maximum potential impact across the asset classes described by the 5 transmission mechanisms. So what we can see here is a mark sheet for potential impact where 1 is negligible and 5 is strong. And just briefly, what we can see is that loans and private equity, according to our assessment at least, and it is provisional, I would stress, are likely to have the greatest potential for real economy impact, particularly through the adoption of sustainable practices channel, which also, if you're looking horizontally, is one of the highest impacts of the 5 across all asset classes. And then similarly on the other side, passive public equity and hedge funds are likely to have least impact overall. And this is counter perhaps to some perceptions we might see about the influence of hedge funds and trends towards greater asset allocation to passive public equity indices. Next slide, please, Krista. So this is just another representation of what we saw in the previous slide. And just expanding a little bit, we find that the several asset classes, as you can see here, have fairly limited potential for impact. And going beyond the way that we've sort of artificially separated items here, impact can actually also be contingent on coordinated action between asset class, across asset classes, and in other cases, maximizing impact depends on factors outside investors' direct control. So this is very much early work, but it does support the claim we made early on that holding green assets alone is insufficient for generating the sustainable outcomes that we want to see. So next slide, please. As Krista suggested, we did sort of ideal type profiles across all the asset classes in the paper. We don't have time to go over all of them, but just quickly, for an impact maximizing bond investor, what we might see is behavior like incentivizing issuers to lower the cost of capital by using sustainability linked bonds, where coupon rates are linked to specific KPIs, pushing for sustainability risk adjusted alternatives to major liquid indices and helping facilitate inclusion of sustainable bonds in current indices, demonstrating the lower downside risks, if any, associated with sustainable bond issuance, Publishing and communicating clearly a net zero emissions compatible stewardship strategy, notwithstanding the limitations on shareholder engagement that are just not available to bond investors. And then potentially reducing the potential for negative spillover effects at the systemic level associated with mitigating the concentration of sustainability risks. And obviously the transmission mechanisms that we've identified apply in fairly complex ways, in different ways across the asset classes that we've been looking at, which is just this next slide demonstrates visually, but in the interest of time, I'll just keep moving. So finally, what are the implications for manager selection and strategic asset allocation? Because obviously we've been separating asset classes and coming up with ideal types and so on, but the vast majority of investors have multi-asset class portfolios. And since impact varies by asset class, the potential for impact also depends on portfolio composition. So on the next slide here, another sort of illustrative diagram we've put together, graphing a risk return profile against the potential impact by asset class that we showed earlier. So what are the options available to asset owners potentially seeking asset managers with strategies most closely aligned with the ideal types? And I'm sure that we'll have plenty of debate about what those ideal types actually should look like in future work, and engage in strategic asset allocation by overweighting the high impact asset classes. So this, according to our analysis, would mean more fixed income, particularly loans and private equity, and less passive listed equity. So just finally, to close out, the options for future research in this area include really exploring the degree of empirical support for this sort of assessment, trying to quantify the magnitude and dynamics of each of the transmission mechanisms, and look at some of the complexities and interactions between both mechanisms and across asset classes. And Aniket's just turned his video on, so I think that means I have to stop there. But thank you for bearing with us and look forward to your questions.
Krister and Alex, thank you very much for a wonderful paper looking at how sustainable finance is linked, if at all, to the real economy. Thank you both. Next presentation is from Yupu Zhang, whose paper is titled, "Does Green Finance Reduce Pollution? Evidence from a Government Pilot Program." Yupu, over to you.
All right, thanks, Anik. Let me share the screen now. All right. Okay, first, thank the program committee to include our paper in the conference. It's my pleasure to present this work. It's a joint work with Zhiyao Jiang from London School of Economics, and also Dragon Tang from the University of Hong Kong. So this paper examines the spillover effects of a nationwide green finance policy, the Chinese green finance pilot zones. So as many of you may know, that China experienced a rapid economic growth in the recent 40 years, but at the same time, those achievements are at the expense of pollutions and worse air qualities. In 2014, Premier Li Keqiang declares war on pollutions, and 4 years after, a lot of scientists and also households even in China, they find that their air quality actually improves in the recent 4 and 5 years. So the natural question to ask is, why is China a pollution war? I can make an analogy to Chinese rapid economic growth. So in the late 80s, in the late 70s, so China opened the markets, and the so-called opening up policy launched a lot of special economic zones, including Shanghai and Shenzhen. The logic behind these pilot zones are basically those pilot zones are given preferable policies to those areas. And secondly, there is economic tournament effects among local government officials, which means that economic growth is a major consideration when promoting the local government officials. However, this situation changes in 2017 in the 19th National Congress, since the President Xi Jinping proposed this lucid waters and large mountains are invaluable assets. So basically in China, they treat economic performance and green performance as equal factors when they're assessing the local officials' performances. So, so in 2017 June, China launched its 5 green finance pilot zones. As you can see in Xinjiang province here, Guizhou, Guangdong, Jiangxi, and Zhejiang, 5 provinces. So what's this pilot zones for? So basically, these pilot zones are trying to enhance the role of green finance in the domestic financial institutions, for example, the banks. So banks will assess the green loans they lend to the firms. When they try to allocate the credit, they will consider the greenness of their loans and their whole loan portfolios. So in this paper, we use these quasi-natural experiments to explore the direct and spillover effects of the world's first nationwide green finance policy. We find that after the launching of pilot zones, there's an improvement in air quality in all the regions. However, we find that non-pilot zone areas actually improves more in their air quality compared with pilot zone areas. So this is a very interesting finding, because normally people will think that pilot zone areas will have better performances. So our story here is that there exists a spillover effect. So non-pilot areas, they try to apply for the second round of green finance pilot zones to get favorable policies, so that they try to improve the environmental performances right now and to show their efforts and ability to be included in the second round. So this competition among the local government officials drive these spillover effects. And we will provide evidence for that. So for the time of interest, let me jump the data part. So empirical design is a difference in different methods. The treatment group basically is the pilot zones, and the control group is the non-pilot areas. So because air quality in China is pretty have a clearly cyclical pattern, so we filter out the air quality index. We also control for the local economic activities that also affect the air quality. So let me provide a little bit anecdotal evidence. So this is internal official documents in Jiangsu province, which is located above the Zhejiang province. So in their documents, they said that they try to develop green finance and to try to apply and establish the second national green finance pilot zones. So actually, those incentives exist in other non-pilot areas. So this is another anecdote that already 9 cities plan to apply to the second round of pilot zones, and the program is expected to expand. So our specification is the main variable we care is the AQI, the air quality index, which measures the particles in the air, including like PM5, PM2.5. The higher the index, meaning you have more disastrous particles, meaning the worse the air quality. And you can see here from the graph, this is just a simple plot of the air qualities after removing the cyclical patterns. You can find that after the launching of pilot zone in 2017, on average, there's an improvement in air quality. The air quality index decreases, meaning the air quality improves. However, the blue line, which is the non-pilot zone areas, actually improves more. And also you can see from here that there is a parallel trend before the launch of pilot zones here. And we can also see the results from the regressions. Basically, after the launching of pilot zones, non-pilot areas actually improve more in their air qualities compared with the pilot zone areas. So this is some robustness. We try to look into subsample analysis. We also do a matching on the characteristics, including previous air quality, previous GDP growth, and population and stuff. So this next, we look into the channels through which the non-pilot areas improves more in their air quality. the first one is the promotion incentives. So there is a very interesting setting in China is that in the province officials, when they become older than 65, they no longer have the chance to get into the second term. So we look into the leaders, the local leaders that have older or younger. So basically the idea is the younger officials, they have more promotion incentives so that they will try to improve their air quality more to be selected into the second round of pilot zones. And the second one is the political influence. So let's say if you are local officials in the non-pilot areas and you want to enforce enforce the environmental policies, but now you have private firms and SOEs, the state-owned enterprises. You only have to you can only enforce to the private firm because SOEs, they have more bargaining power when facing the inspections and regulations. So that in the provinces with higher SOEs, you will find that it's very hard to enforce that. So that in the low SOE share provinces, their air quality will improve more. So this is the regression results. You can find that this is a near term, meaning that you have the ability to be selected into the second term. Your air quality improvement is about twice of the magnitudes compared with the retirements, meaning that you don't have the second term. So this is the regression for the SOEs. You can find here that basically if you are in a province with more SOE shares, your air quality improves less. So to briefly conclude here, so we examine the effects of place-based green finance policies. We also look into other perspectives, but due to the time limits, I don't have time to talk about it all. But we find on average there is improvement in the environmental performances, but also we find a spillover effect that other regions they try to boost their environment performance better than the pilot zone areas. And this is all my presentations, and thank you all for listening. I'm looking forward to the suggestions.
Thank you very much, Yupu. Fascinating geographic exploration of green finance and sustainable finance, and lots for us to think about, perhaps some counterintuitive results from your study. So thank you very much, Yupu. We now have Ellen Quigley, who will be presenting her paper titled Universal Ownership in Practice, a Practical Positive Investment Framework for Asset Owners. Ellen, greetings, over to you.
Thank you very much, Aniket. And I really enjoyed both of those talks. I can see why we're all on the same panel, highly relevant. I'm going to try not to repeat too much from what the first paper covered, because I agree with quite a lot of it. And try to cover things that that might complement it. So first, I want to start with a bit of a paradigm shift so that we're all on the same page. I think for the purposes of this analysis, it's worth talking about universal ownership theory for a moment, which is just the idea that, say, if you're a large pension fund or a university endowment or an insurance fund, that the fate of your fund is tied more to that of the economy as a whole, the real economy, and the financial system as a whole, much more so than to the performance of any given company. So, for example, you can imagine a case in which a company like Walmart might decide to pay its workers as little as possible or externalize the costs of pollution in order to cut costs for them as a company. But the kind of macroeconomic effects of doing that, if you combine that sort of decision making with the same sort of profit maximizing decision making on behalf of companies throughout the economy, the aggregate effect is that you end up with a lot of externalized pollution and a hollowed out middle class, both of which hurt the macroeconomy, especially in the long term. So concretely, what this means is that you're really no longer looking at, and I'm just going to use the example of climate change here for much of this paper, but other systemic risks apply. you end up with a situation in which you're looking at climate impact more than climate risk, which makes this analysis kind of the opposite of ESG, you could say. So ESG is often looking at the risk to the portfolio of physical or legislative climate effects, whereas what we're talking about here is the effect that the portfolio has on the real economy, on emissions that contribute to climate change. So that's kind of the paradigm shift for this discussion. And why that's important is that, everything from TCFD to SASB and the like, tend to deal with things that are material to a company's finances. But what we're really talking about is the ways in which those companies contribute to changes in the real world. So if that's your lens, then you want to look at a number of things differently. So active ownership is a lot of it is centered around trying to get companies to disclose, to report, to adopt voluntary standards, and so on and so forth. So this is the one area in which I disagree with the first paper, which was otherwise pretty much right in line with mine. If you look at the literature on shareholder engagement, there actually isn't a lot of evidence of real world effects in terms of actual reductions in emissions and the like. What you see is a lot more success on things like disclosure. And if you then go look at all of the literature on disclosure, you find that there is very little, if no, correlation between heightened levels of disclosure and actual improvements in environmental performance, which is a bit of an issue. In fact, sometimes there's a negative correlation because companies that have particularly bad environmental record will simply disclose to kind of get investors off their backs, but without corresponding increases in actual pollution management, and so on and so forth. So what you would need to improve active ownership, if you had this universal ownership lens, would be to kind of hit at more high impact real world goals for engagement. So kind of making disclosure a means to another end, the other end being things like actual reductions in emissions. There's also evidence to suggest that you end up with a greater effect when you vote against directors, do things to do with executive pay, voting against auditors, and so on and so forth. So we don't have time to get into the detail there, but the idea is to, go with, more voting against directors than advisory shareholder resolutions, more actual targets or actual outcomes as opposed to just disclosure resolutions, that sort of thing. Then you're really dealing with allocation of capital. And as the first paper laid out very well, that has to do with other asset classes. It's really not about public equity, which again is kind of not in line with what we normally see with ESG investing. So I would just say, what your highest impact is going to be with venture capital and other early stage investments. That's where you want to have a really strong filter on what you actually provide new capital to. Also private equity, that's also growth capital often, but the kind of the major source of new capital for fossil fuel projects, for example, is bank lending and bonds. So about 90% of new capital to fossil fuels is coming from debt markets, and a majority of that is bank lending. So that actually ties into the active ownership argument, because what you want to do as an active owner is directly engage with your commercial bank as well, because they have a big role to play in terms of lending and new capital allocation to companies, and especially in the case of climate for fossil fuels, fossil fuel expansion, and so on and so forth. I also think that it's important to look at the transition from the primary market to the secondary market. So, the moment that a company shifts from the primary market to listing on the stock market, for example. So, an IPO or initial public offering is a big opportunity to allocate more or less capital to a company depending on their bona fides. So that's a very important consideration when it comes to climate change, for example. Giving a signal to companies that they won't be able to raise as much capital if they don't have an aggressive transition plan is quite important. And then finally, we end up with land and real estate. for real estate, a pension fund or a university endowment, for example, might be able to issue green bonds to retrofit all of their buildings, for example. In the current low interest rate environment, that makes a lot of sense. It also helps to provide new investment options for other players in the market who want to be able to invest in things that will help contribute to the decarbonization of the economy. And there's a lot of dispute around green bonds and how useful they are in terms of the transition. But certainly if you were to yourself issue a green bond in order to retrofit all of your buildings so that you decarbonize rapidly, I think that's an unambiguous plus. And I'll just kind of rush through this a bit, but there's some stuff in the paper about how universal owners can contribute to policy and forward signaling around especially things like fossil fuel infrastructure lock-in. So you can help to kind of anticipate within the market the inevitable shift towards things like electric vehicles or the end of coal and gas plants for electricity. Those three examples are not random examples. There's evidence suggesting that coal plants, gas plants, and electric vehicles are the top three sources of potential lock-in of fossil fuel infrastructure. So it's particularly important that we avoid building that stuff in the first place, instead signaling that we don't expect electric or non-electric vehicles to be worth anything a few years from now in terms of resale value. And same with coal plants, they're already reaching zero or negative value in some markets because of this very factor. Finally, it's worth talking about what sort of metrics that we're actually gunning for here. I said before that I don't think disclosure is a good end goal for any of the kind of engagement that we would want to do. But equally, if you want actual metrics as to the real world performance of a company according to environmental metrics, you want to be looking at things like capital expenditure, R&D, and acquisitions and disposals, and all within a very short time frame. So you want to know, is this year's capital expenditure compatible with the Paris Agreement, and so on and so forth. If you don't have those numbers, you really don't have a sense of the direction of the company, and therefore don't have a sense of, for example, whether to vote against their directors. So I'll leave it at that. Thank you very much. Looking forward to your questions.
Ellen, thank you very much for that presentation and for your paper, which is indeed a paradigm shift, as you mentioned, about how the investor community is and perhaps should be thinking about ESG investment and sustainable finance more broadly. So thank you very much for that, and look forward to Q&A in a few minutes. And now we have our fourth presenter, Adrian Lam, who will be presenting his paper titled, "Do Health Hazards Reshape Firm Boundaries?" Adrian, over to you.
Thank you, Andy. Let me just share my screen. I hope this is working. Please let me know if it's not. So thanks for staying. I'm very excited to talk about my paper, "Do Health Hazards Reshape Firm Boundaries?" So let me start with an anecdote, the Monsanto deal. This is Roundup. It's a weed killer, one of Monsanto's signature products. It uses glyphosate, a chemical ingredient, to kill weed. Now, in March 2015, glyphosate has been listed as a probable carcinogen by the WHO, and since then, the number of glyphosate-related lawsuits filed against Monsanto skyrocketed. So, which is very interesting because in 1.5 years' time after this listing, the German chemical giant company Bayer proposed to acquire Monsanto for $66 billion, and this completed in less than 2 years' time. And this is when things went crazy because, bam, there were 3 Roundup-related rulings that ruled against Monsanto and Bayer, and the compensation and damages ranges from $80 million to $255 billion. So this is huge, and from hindsight, this seems to be a very bad deal. So this kind of leads to a very natural question, which is, did Bayer take the health hazards into account when acquiring Monsanto? Because this information was known a few years ago, and did this information play a role in Monsanto shareholders selling Monsanto? So this basically leads to my research question, which is, do health hazards reshape firm boundaries? So this is an interesting question in the sense that health hazards usually affect customers and employees. and they are non-financial stakeholders of the firm. So do firms take into account these kind of environmental and social considerations when they are formulating corporate policies, when they're formulating what they want to do? So I've got limited time, so I'll just try to answer two questions. The first one is, how do health hazards affect resource allocation? Then I'll also try to see, can market forces discipline industrial pollution? So to do so, I combine data from various data sources. I use SBC Platinum for asset transaction data, CompuStat for firm financials. And the third one is more interesting, which is the US EPA Toxics Release Inventory, the TRI. The TRI is a plant chemical year level data. It tracks the production and management of toxic chemicals and the chemical-specific abatement activities. It is a long time series starting from 1987. It tracks more than 600 toxic chemicals. Now, I just focus on one very particular type of health hazards, which is carcinogenicity, whether a substance causes cancer. So to obtain this information, I refer to the US report on carcinogens. So this is a science-based public health document where scientists meet and evaluate whether there's sufficient evidence to list substances as either a probable or a known human carcinogen. So again, this is also a very long time series with 14 editions. Now there are more than 200 plus carcinogens in this report. So let's go to some analyses. So the first set of analysis that I'll show you is at the firm year level. The primary question is, do increases in the awareness of health hazards affect firm size? So I use the report on carcinogen listings, like new listings, as shock. So the argument is that when the scientists add a new carcinogen to the report, it will raise the awareness of the health hazards of using that particular chemical. So since there are 14 editions of this report, I use a pooled definitive model. I assign firms into the treatment group if at least one of the chemicals that they use have been listed as a new carcinogen, or if one of these chemicals have been upgraded as a known human carcinogen. So here are the results. I look at firm size, and what I find is that on average, the treated firms reduce in size. So when I look at assets or net PP&E or employees, they give me some very similar estimates. They reduce in size, and this reduction ranges from almost 5% to 8%. The effect is also very pronounced when we look at firm sales. So by the manager, it kind of suggests that firms are either making these assets obsolete or they are selling them. So what I did is to focus on some asset transactions. I try to look at these kind of Hazardous asset transactions where it is most likely to relate to the use of these carcinogens. So what I find is that, well, it's an active market and the acquirers usually have more diversified cash flows. They're more likely to be judgment-proof in the sense that they use more variety of carcinogens, and then they have lower total assets, lower tangible assets, and lower cash-to-asset ratio, which kind of suggests that the expected payoff from a litigation from the perspective of a plaintiff should be lower, which suggests that maybe they are better at managing this kind of litigation exposure. So what is interesting is that I find a positive deal announcement return for both the targets and the acquirers. This suggests that investors think that the corporate assets are changing hands from better uses. So I tried to explore the mechanism that drive the results. And as expected, litigation risk seems to be one of the key channels. For the treated firms, I find the number of environmental, health, product liability lawsuits increased. Then an alternative story could be that maybe people now are aware of these bad impacts of using these products and there's a reduced demand. So to answer this, I try to look at average firm level markup, which is some sort of a proxy for market power. So if the reduction in demand is really the driver, then we should expect firms to lose market power over consumers, then markup should decrease, but markup is unchanged. So this kind of suggests that litigation risk seems to be the driver, and health hazards do reshape firm boundaries. So what is interesting now is that, well, firms sell assets, so do this affect how they pollute? So to answer this, I move on to a plant chemical year level analysis. The primary question here is, do increases in awareness of health hazards deter the use of carcinogens? Here I use a fixed effects model. The dependent variable is very granular. It's at the plant chemical year dimensions. Then the key independent variable is this ROC indicator. It is an indicator that takes on a value of 1 if a chemical has been listed as a carcinogen in the most recent report, 0 otherwise. So let's look at whether firms take actions individually. So in the first column, I have this production variable. It is an indicator variable that takes on a value of 1 if a firm reports a positive amount of that chemical, 0 otherwise. So this is extensive margin results. So if we expect firms to terminate production, then this coefficient should be negative and significant, but this is not the case, which suggests that firms are continuing with the use of these chemicals. What about, do they mitigate pollution on the intensive margin? So here now I move on to column 2. I use log pollution as a dependent variable. Pollution here is measured at pounds, the weight. So now I find that firms reduce the amount of these newly listed carcinogens by almost 20%. They are also more likely to carry out chemical-specific abatement activities, and these abatement activities can be substituting raw materials, improving the production process. So I think all in all, this suggests that firms continue with the use of these chemicals, but then they use it at a lower amount. Now, what about on the extensive, in aggregate? Well, now I'm aggregate the data across plants so that this is a chemical year level data. And this is what is striking, because the amount of the pollutants or the number of pollutants don't change when we look at the aggregate level. So we have on average some reduction in individual firms, but nothing on the aggregate level, which means there should be some sort of a concentrating effect in the use of carcinogens. And this is what I show in column 3. I look at the log of the HHI index, some sort of a concentration measure on the use of the carcinogens. And when these chemicals are listed as a carcinogen, they become more concentrated, which suggests that market forces are able to provide economic incentives for individual firms, but then it doesn't seem to be sufficient to deter aggregate pollution. So this is basically what I have. I find that health hazards affect firm boundaries, litigation risk seems to be the primary driver. Market forces provide strong incentives for firms to mitigate pollution individually, but not in aggregate. So this is basically all I have. Thank you for attending. I'll be happy to answer any questions or have a chat afterwards. Thank you.
Adrian, thank you very much for a fascinating presentation looking at a very micro impact of sustainability at the firm level, but with huge macro implications. So thank you for that. We now are entering the Q&A session. I see that there are a few questions on the right that I will quickly go through. So let me start with the top question, and this is for Alex and Krister. It's really a question about how, in your paper, are you assessing the potential impact of sustainable finance for the different asset classes? So, Krister, if you're still with us, perhaps you can just respond to that, and then I will ask a few questions to all 4 of you.
Hi, yes, so my colleague Alex had to go to a different engagement, but I am here to answer any and all questions. And to answer that question, our methodology was quite subjective, as I think Alex alluded to quite explicitly. We're not pretending to have a clear and very well constrained and defined quantitative answer at this stage. So we were really just going through for thinking about the maximum impact, we were thinking about what are the constraints, legal or logistical or otherwise, like what is the framework within which each asset class or investor operates. So, if you're a share owner, you have certain shareholder rights that are guaranteed to you by law. And of course, those vary by jurisdiction and whatnot, but those are essentially similar everywhere. But if you're a bondholder, if you're a lender, you have different rights, and you don't have shareholder rights. You're not an owner, you're a lender, and you can have covenants to your loans, or loans tend to have conditions attached to them more often, in bonds, less so. And so we were just basically going through what are the tools available, and within that framework, what is the sort of maximum potential climate or sustainability impact that that framework would even allow, and then sort of grading that on a subjective scale.
Excellent. Thank you very much, Krister. Maybe I'll ask, going on the back of that, a question for all four of the presenters. Say a few words about methodology and sustainable finance and your particular research topics. One of the things that strikes me about this space is that it really, the methodologies used to answer the questions range from conceptual and empirical, conceptual analysis to highly empirical and econometrics-driven data analysis. What are your thoughts about how methodology in the social sciences needs to evolve, if at all, to respond to the questions that you guys are all focusing on one way or another? I don't see you. If you want to respond to the question, you'll have to turn on your cameras. Thank you. Ellen, over to you. And then others, if you want to respond, please just turn on your camera and I'll know you have a comment. Ellen, please go first.
Thanks, Aniket. Really just jumping in because there seemed to be a pause, but I think the main thing in terms of social science research is to make sure that you're making use of all of the social sciences. So sometimes you'll get okay, so let's take the example of evaluating the effectiveness of screening within a portfolio. So you can take very much a kind of social movements view and say that the public announcements associated with divestments, for example, can change social norms and have an effect on public support for certain legislation and so on and so forth. You're going to miss that analysis if you're only using quantitative measures of say effects on share price and so on and so forth. But equally, it is important to note the effect on share price. So you should also use that analysis to see what an effect might be, from a purely financial perspective. So I just think making sure that you make best use of all of these methods is actually critical, particularly for this subject matter.
Yeah, I can, if I jump in, given the similarity of our papers, I couldn't agree more with that. And in fact, I think when it comes to climate, so our papers, it ends up being a lot about climate, even though we use the word sustainability. And I think in climate, it's important not only to make use of all the different social sciences, but also to really have that linkage with natural science and to use those data points. So, there are people in my research group who are working with, we have some collaborations with satellite firms to come up with better data, plant level data, location, a location database of, for example, cement or steel or coal plants that are worldwide, and then you can geolocate them, and then you can, and then I know there's these, satellites that are, my understanding, in the next few years we'll have detailed satellites that can actually measure plant level CO2 emissions, that kind of stuff. So when you have, really plant level specific data, you can really hold the companies to account in a much different way than you can by just sort of relying on them to disclose, when obviously their incentive to disclose is just to say the rosy things, or even in the worst case to just disclose just to tick that box of, because some ESG frameworks say disclosure gets you brownie points. But yeah, and I think our paper really started from the idea that because we wanted to engender a different sort of conversation, kind of like Ellen, that we needed to have this conceptual framework first that then could be in future strengthened with quantitative evidence. Like we think and we hope that a lot of our points, which are now quite subjective and sort of preliminary analysis, that we could find data sets that would bolster our case for those individual asset classes, and you could really branch off. But without sort of first setting out what we're trying to look for, you can't really then drill in deeper. And because obviously the deeper you drill, the less broad you can be. So there's always that balance.
Great. Adrian and Yupu, from our more quantitatively minded scholars, what are your thoughts about different approaches to answering the questions that we're all confronting? Adrian, why don't we start with you? And
sure. Thanks. I think this is can you hear me? Yeah. So I think this is a very important question. So I think the thing is different approaches should go hand in hand. So I think having these kind of top-down theoretical projections or economic arguments are very important, because intuition matters. Sometimes we have intuition that leads to different predictions. So theorists should do the work, give us some conceptual guidelines, and then empiricists should kind of think, okay, does the evidence support that? And then there's also sometimes some very cool conjectures, but then some limitations on the data. Then on this end, perhaps having this kind of machine learning AI strategy that generates data will also be very helpful. So I think the thing is that different approaches should really try to go hand in hand. And one more very important thing is that even though sometimes methods are hard to communicate, it is extremely important that we are able to deliver a very simple message using no matter how advanced techniques that we have. Thing is, we have to do things right, and we have to speak the truth. And I think that's my take on this.
Thanks, Adrian. Yupo.
I want to follow up on Krister's points. Actually, I think he mentioned that there are a lot of more and more data points coming out from different sources. For example, satellite data. From my knowledge, that Chinese government already using those satellite data to detect like fraud. For example, there's some public listed Chinese companies that they try to report their sales, and this the Chinese government try to use satellites to find that how many boats actually sent to the overseas, and to count how many the sales, the real sales. I think those data are generated to help not only from academic sides, but also from the policy, the regulation sides. And with more and more data coming out, I think empirical studies, or from my side, applied econometrics, could be more interesting, and also for the policy implications.
Excellent, thank you. That's a very important set of observations given the heterogeneity of methodologies in these four papers. If you look in the Q&A, there are some specific questions, I think, for the authors, and those might actually be best addressed one-on-one. So I've just asked the authors to respond perhaps privately to the speakers, so we can have some more general discussion. Another question that I'll throw out to the group, all of your papers at some level are looking at measurement or impact. How do all of these sustainable finance and its various appendages impact the real world, and all of this in quotes? How does it drive change? Give us some of your reflections on, given the fact that so many of these topics are system level changes, where you have public policy, you have consumer behaviors that are changing or not, you have the Earth system that is changing. How important is it for us to still be talking about the standalone impact of sustainable finance or ESG investing versus thinking about the whole system, sort of like how Ellen is doing in her universal ownership framework, as opposed to, again, looking at the standalone contribution of sustainable finance? And maybe I will ask Ellen to start, and then over to Adrian, Krister, and Yupo if you have thoughts as well.
So I think the impact of standard ESG methods or apparatus is negligible, if not kind of counterproductive, because I actually think that a lot of, especially consumers or non-experts, will think that they're doing their job after having signed up for an ESG product that's actually useless. So I think it might actually be harmful, our current approach to ESG. And I realize that's a controversial statement, but it's precisely because it doesn't have that kind of impact lens. It tends to have the climate risk lens instead, which means that you can't look at these broader system changes that you've mentioned, Anikit. I think the whole system view is the only thing that gives you the appropriate lens to address things like, and I have to say, I don't think that we can wait for consumer-led change I think that's why you need to look at the financial system, because it can actually help shape some of those trends. A lot of things happen by default. If you look at the literature on, social norms, or, nudge theory and all of that, humans are highly social and can be influenced greatly by what's available and what's the default. So anyway, yeah, I'm very much biased, but really don't think that current approaches to ESG are going to have an effect.
Adrian, what are your thoughts?
I don't really have any particular insights, but then I think one thing about ESG as a whole is that it's really new. We kind of don't really know what is going on. So having a holistic system view is very useful in understanding the whole picture, but then sometimes it's also useful to look at some particular aspects just to see what is really being measured, what is really going on. I think, yeah, that's my take. As again, I think different approaches are really complementary. And then given this is a very new field, I would like to see more research to really have a more informed discussion on this.
Great. Krista and Yupu, any thoughts about thinking about the system versus thinking about individual actions?
As much as I really think systemic thinking is important, it almost, when you do it too much, it almost ends up being too big picture. And if you say everything affects everything else just from an analytical standpoint, then it's hard to sort of pin down recommendations for how some specific sector should change. So I think even just from a practical point of view, like those of us who are here have done research in and have studied the financial sector, or in your case, Annika, work inside the financial sector. It has a very important role. It's worth thinking about the connections of the financial sector to various other sectors, to public policy, to real economy corporations and things, but it's still sort of useful to start your analysis somewhere. There's a merit to having an analysis that's, finance sector specific, and having another analysis that's, non-financial corporate specific, and another analysis that's government specific, looking at public policy and, the political considerations of policy decisions. And because, there are different shades. I wouldn't go so far as to call ESG sort of negligible or counterproductive, even though I think I agree in a lot with Ellen, and our views are actually probably quite close. But I do think it's been valuable in starting a conversation, and that even if it is the risk side, that I think it has been important for the financial sector to realize that there are these really material risks that are not just the ones that come from, profits and losses and like very narrow, balance sheet, like a bad acquisition or something, like a financial or a management decision relating to the company's performance, that actually, hurricanes and vulnerability to floods and carbon emissions that might be taxed more, and human rights abuses and things, they really do matter, and with all the caveats around how to quantify them. Like, I actually think that ESG, I find ESG to be a little like the problem I most have with ESG is that it folds too many things into one, right? Because the ES and G are quite separate things. And I think that's why it's, I focus on physical climate risk, which is a subset of climate risk. I think climate risk is a sort of an area that's sort of big enough to focus on, that's worth just considering as a separate unit. And I think sort of someone should really consider social risk and as a sort of separate unit, and those should, like, that's sort of talked about less. But I really think, like, yes, it's maybe useful as an umbrella term, but I think like it's breakdownable at least into the 3 letters, and maybe into like 4 or 5 sort of big chunks that themselves matter enough that like should really be discussed on their own merits. Like when you just make an ESG score and you have these, these companies that compile an ESG score and they take an average of 100 indicators, like that doesn't tell you anything. The ESG score, that it takes some numerical value of human rights and some numerical value of CO2 emissions and some numerical value of flood prone, and then tries to sort of equate those apples and oranges together. That's, doesn't actually tell
you. Yupu, a thought?
Yeah, so my understanding about this ESG and green finance is broadly in 2 ways. The first is the public sector. For example, like China, there's a top-down approach. Central governments set the rules. The central banks, they have to measure the greenness of their loan portfolios, so such that each commercial banks have to do their own work and let the they have to decide how to allocate the credit according to the greenness of their projects. And second is from the private sector or the financial sector. I think there's a demand and also the supply, right? So from the investor side, they're growing awareness of the importance. So investor demand those, so they will push those companies to do like green things. But also is from the firm side, there's a lot of like CSR, like corporate social responsibilities. Those large firms, the managers stand out to say like, we cannot only care about profits, we have to care about our employees, we care about other stakeholders, which in turn make the whole system works. It's not only to push in one way that you can think the whole system will work.
Wonderful. Thank you all very much. I'm conscious of time, and I have many more questions to ask all of you, but I guess we'll have to do that on another occasion. So with thanks to all the panelists and the speakers, again, we had Alex Clark and Krister Koskelo, Yupu Zhang, Ellen Quigley, and Adrian Lam. Thank you so much for your wonderful papers and great work. We have a few minutes of networking, and I believe our conference organizer is going to soon kick us out of this speaker platform so that everyone can speak with one another. But just a thanks from my side for a fascinating conversation, and we'll talk again soon. Enjoy the rest of the conference, everyone. Thank you.
Thanks. Thank you.
Good.